This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through first of all and begin to look at net assets and how you can value a business using your net assets. And effectively all we're going to go through and do is take the balance sheet within the financial statement. So looking there at the book value of your assets, be it current and non-current, and then deducting the value of your liabilities, current and non-current. And that will then give you the value of the equity, isn't it? Okay, assets less liabilities equals equity based upon the accounting equation. So that's effectively what your book value is in terms of your net assets. But it's rubbish. Okay, why is it rubbish? Well, different areas. If you think about your non-current asset, you capitalise it at cost. What do we do in terms of accounting treatment from IAS 16, property, plant and equipment? What's the subsequent treatment once you've capitalised an asset at cost? You will then depreciate it. Okay, so if I bought an asset several years ago, its carrying value will be much lower than what potentially its market value actually is. You know, if you think about a building, you will have capitalised it and depreciated it. Buildings tend to go up in value, so therefore will have more worth than what they are shown at within the balance sheet. If you think about liabilities, not all liabilities may be recorded. There could be a contingent liability that's disclosed in the financial statements and the notes to the back of the accounts. It might be that that contingent liability will result in some form of payment, but you don't know how much because you weren't able to measure it reliably from an accounting perspective. But from a valuation perspective, you might just want to apply a particular number so that you've got a value of the business in terms of the net assets. You know, if you don't include that liability, the value of the net assets will be higher, and therefore you'll be paying a lot more for the business than what it's actually worth. Again, net assets, book values are subject to all accounting policies, aren't we, in terms of inventory, receivables, so we need to ensure that they are correctly stated. And don't forget your intangibles as well. You know, the net assets basis, take the book value of the non-current assets, where we record your property, plant and equipment because we can measure it at cost, can't we? But in terms of your intangibles, what about those internally generated intangibles? We don't see those appearing within the financial statements, do we? We don't see the brand name, we don't see the customer goodwill, do we? But they do have some value, so it will be important that we can attribute an intangible value on top of the net assets value. Okay, so book value exists. We tend not to use it very much. Just be aware, if it were to be used, it would be used in a very, very capital intensive business whereby there are huge amounts of property, plant and equipment, okay, and not much else. That then goes through there and brings us to what else do we use then if we're not going to use the book value? Well, we could go through there and use the realizable value. So what could you go through there and sell each individual asset and liability for if we were to go through there and liquidate or wind up the business? So your realizable value tends to be the minimum value that you will go through there and sell your business for. Okay, so effectively it's the minimum value that the seller would accept. Okay, however, if you then go through there and look at your replacement value, you know, this makes a little bit more sense, doesn't it? Because instead of going through and looking at what you can sell each item for, maybe you can look at what it will cost to replace that item. So what is the revalued value of your building, as opposed to looking at the carrying value? Let's go through there and look at the replacement value of it. Okay, and therefore that will go through there and look at the maximum value that the buyer would be prepared to pay. Because if you look at each individual asset within the financial statements and look at its replacement value, so how much it would cost to buy now, then you just go out and buy those assets yourself, couldn't you? Okay, and start up your own business. So therefore, that you wouldn't want to pay any more than being able to set up the business yourself from scratch. Okay, so that would therefore be the maximum value that the buyer would be prepared to go through there and pay. Okay, so it's quite important. Okay, so within those asset-based valuations, I think the key bit that we touched upon was the fact that none of them go through there and incorporate goodwill or any intangible. So what we need to go through and do is calculate a value of our intangibles, a CIV, a calculated intangible value. And it's a very theoretical way of being able to go through there and calculate the value of your intangibles by effectively comparing what the industry goes through and generates as a return on its assets. Because if we can go through there and work out a return of what the industry generates on its assets and how that helps it generate its earnings, then we can compare our earnings that we generate to an industry average amount of earnings, okay, based upon the return on the assets that that industry is generating. Now, if our return is greater than the industry return, then we will therefore make more earnings than what the industry does. Those excess earnings can therefore be attributed to the value of your intangibles. Okay, that's what we assume. Any excess earnings due to an excess return that we make come from intangibles. And if we can work out the value of those earnings and the excess of those earnings, then we can discount those earnings back to present value, and therefore we have your calculated intangible value. Okay, so it's all about thinking about what the industry returns and what we return. Once we know that, can we work out an excess return based upon the level of earnings? Those excess earnings are attributable to the intangibles, and therefore we then discount those extra additional earnings to present value to be able to go through there and work out the value of the intangibles. Okay, you can then add that on to the value of the net assets to work out the value of the business. Okay, there we go. So let's go through and have a look at the example. The example wants us to go through there and work out a calculated intangible value. Okay, now the industry return on tangible assets is there at 12%. Okay, we need to make the assumption, and it will always be the case, is that that is a pre-tax return. Okay, because when you work out the return, you take your profits before any tax and divide that by your assets. So here your tangible assets. So when we start thinking about looking at our excess return, which we will in a moment, so if we set it up or begin to set it up, our excess return is going through there and making sure that we look at our pre-tax earnings, or your pre-tax profit, which is just going to throw a bit of a spanner in the works, because here we are given our earnings, and your earnings are effectively your profits for the year, or your profit after tax, aren't they? So when we're looking at the earnings that we generate as a business, okay, we need to go through there, don't we, and work it based upon pre-tax. Okay, so when we're looking at your excess return, first of all, we will need to go through there and look at Pepper's pre-tax earnings. And then what we need to go through and do there is just check, are we actually earning more than the industry? And if so, work out what we should be earning based upon the industry average. Okay, because what we have at the moment is that we are earning 0.58 over the 1.85. I suppose technically I should work out the earnings as before tax, but let's not worry at that point there. 1.58 into 0.85 is approximately 31.4%. You can see if that was to be post-tax, it would still be comfortably above the 12%, wouldn't it? Okay. Now what we need to go through and do then is start to go through and think, well, we can work out, which we will in a moment, Pepper's pre-tax earnings. But what about when we compare that to the industry return, to what Pepper's earnings should be. Okay, so your expected pre-tax earnings. So what do we expect based upon the industry return? Okay, because what we've got there is at the moment the industry is generating, is it 12%? If we apply that 12% to our assets that we have at 1.85, does that give me there 0.222? Okay, that would be our expected earnings if we were returning what the industry does. But we are returning more, so we need to go through there and look at what Pepper's earnings actually are pre-tax. Okay, that's where we just need to be a little bit careful, because what we are given within the scenario is that we are given, is it the post-tax earnings, is it there 0.58, and we need to then go through there and work them out pre-tax. Okay, well, if the tax is there at 20%, we will have applied 20%, won't we, to the pre-tax earnings to get our post-tax earnings. So those post-tax earnings equate, is it to 80%. Okay, so if we go through there and multiply by 100 over 80, does that go through there and give me 0.725 million? Okay, if I'm then working out the excess return, then if I do 0.725 less 0.222, that goes through there and gives me, is it 0.503 million, and that is the excess that Pepper is generating compared to the industry. Just be careful that there is pre-tax, isn't it? Okay, again, we need to go through there, and when we're looking at the discounting, we need to discount then the post-tax earnings. So if you go through there and multiply by, is it 80%, that goes through there and gives you 0.4024. And then what we have there is they are now your post-tax earnings, which are your excess, and then we need to go through there and discount them back to present value. Again, when we do the discounting here, the way in which calculated intangible values is set up as a theory, we are going to go through there and discount at the weighted average cost of capital. Okay, once we've got the weighted average cost of capital, is that there as 0.8. To work out the calculated intangible value, you do the 0.4024. We assume that it is an infinity perpetuity, again from 1 to infinity without any growth, and that goes through there and gives you, is it $5.03 million. Okay, excellent. There we go. I think you'll find within some study texts they give you a structured 1, 2, 3, 4, 5, 6 order in which to go through and work it. If you want to stick with that, you are more than welcome. I think the key thing here is to remember that your excess return pre-tax, you need to look at your company's pre-tax earnings, and again you'll need to make adjustments for tax there to get the pre-tax figure. Look at what you would expect to generate from your earnings using the industry average and your tangible assets. Look at the difference to give you the excess, work it out post-tax, then discount it as a perpetuity with no growth using, is it there, your weighted average cost of capital. Okay, there you have it. Work through that example again, make sure you're happy with it, and then do the normal. Practice the questions that you've got in the study text and then dive into the revision kit. Other than that, that's all from me for now, until we then go through in the next video and then begin to go through there and look at things based upon an earnings valuation.